Morning, everyone. Welcome to our webinar today, and I'm so glad you make it. And thanks so much for your time. And today, I'm joined with my colleague Atif Mir, and we're talking about Canadians with U.S. vacation property. Just some high level on the cross-border tax issues, and we have some housekeeping rules to say, if you have any questions, just stay to the end or type in your question for now. In the end, we have about 10 to 15 minutes to answer all of your questions. Hopefully we can answer all. If not, we can answer by email. We can chat privately offline. And the second, we will have a survey in the end. So just we love to hear your feedback and also any suggestions, on how to improve our webinar in the future and what kind of topics you will be interested. And the last, we will have the live transcript. So there's a way you can type in, you can make it work on your screen. And with that, we can just start it. And here's the agenda. We're going to talk 5 main things. I know there's so many things to cover, but mainly we're going to talk about some ownership consequences from the U.S. vacation property holding. Then what's the income tax issue? What's U.S. gift tax or Canadian capital gain tax or U.S. estate tax. So after all of this discussion, we can talk about what kind of structures you can have to hold this. Then last, we're going to talk about what you can do if you miss those compliance. So with this, I'm going to hand over to my colleague, Atif, and it's on you.
Thank you, Cooper. Thank you. Welcome, everyone. So as the agenda listed, we will start with the Canadian tax implications of owning a U.S. vacation property. So if you are in the U.S. and you come across a property that you love and you want to buy it for your vacation, you can do that, obviously, but you have to consider the tax implications. Now, you can hold the property in 2 ways. One way is that you just keep it for your personal use. And you go there, you spend your vacation there, share it with your family. In those cases, it's considered a personal property, and it will not be taxable. It's not, there is no income tax reporting obligations associated with that kind of ownership. However, if you rent that property while you are not vacationing in the US, then you have to consider taxation of the income arising from that property. So you will be required to report the rental income in your Canadian and US tax returns. And you also have to consider a T1135 form. A T1135 form is in addition to the personal tax return that the CRA needs you to file annually. And if you don't do that, then there are penalties involved. This form is basically disclosing your ownership in a foreign property, which is earning rental income. Now, if you do not report this form, do not disclose the property on this form annually, you are penalized, and the maximum penalty is $2,500, and it is $25 per day. And so that can be pretty substantial amount if you ignore it.
And if that is comprehensive to cover all of the non-Canadian investments, is that
yes,
right?
Yes, Cooper, thank you. So if you already have a property in the US, let's say you have a $40,000 cash sitting around in some US bank account, and you buy a US property that is worth $75,000 Canadian, it's hard to find that property, I understand, but that will push you over the threshold of $100,000 because it's the combined, your foreign cash holding and the foreign vacation property that will be taken into account, the combined value to be considered you to be required to form T1135 form. So now if you have a vacation property, something you need to consider, and if you start renting it out, then you have to consider change of use rules. What that means is that you were using it for personal reasons, now you are going to rent it. Now there is a deemed disposition under the Canadian tax rules for that change of use. However, you can make an election, and if you treat your vacation property as a principal residence, then the election allows you to defer the gain on the property for 4 years. However, one must go through carefully through the principal residence rules to make sure that your property does qualify to be treated as principal residence. You can rescind that election, but you can also defer the property for 4 years. And
so, yeah, that's interesting. Change of the property to rental use. I know, like during the pandemic, due to the border strict, if you it's hard to travel to the U.S. Like during the past 2 years. Then you turn into that property for rent or Airbnb. So that will be an issue for the Canadian tax. There could be some potential capital gain. And however, for the US tax purposes, it's not deemed a disposition from that change of the use. The only thing to pay attention is that when you claim the depreciation, the cost, you use the lower of the original purchase price and also the fair market value, but only for the building part, not consider the land, because the land is not depreciable assets. And I think then occasionally we talk about if you rent your home to get some rental income. However, the US has a de minimis rules provide an exception. If your rent days is less than 15 days during the year, then you don't need to report that as a rental income, no matter how much income you get from that rent, as long as you meet the 14 days. So I think in Canada, there's not such exemption. You still need to report report income, is that right?
right, there is a concept called reasonable expectation of profit. If you are renting a property and you think you are not expecting to get any profit out of it, then you can escape reporting the income, but or T1130 or filing T1135 form. But be aware that the CRA can come and analyze your business facts and circumstances to see if you do qualify, if there is a reasonable expectation of profit or not. So generally, depending on the situation, it is safer to file a T1135 form in those circumstances.
Okay, very good. Let's move on. We have more slides to go through. And the next, I would like to talk about the sales. And, this is the important part, because for vacation home, maybe you just use it for your personal use without any rental income at all. So, however, when you sell your property, at that time, there will be a huge tax. Withholding tax is always a headache for Canadian, because on the US federal level, they're gonna require withhold generally 15% of withholding tax, okay? And however, if the sales price is below some certain amount, then it could be exempted. It's pretty low, it's like $300,000 US. Probably a condo type of a property in some states, you can find it. Then if it's below the $1 million, the withholding tax rate would be reduced to 10%. Anything above the $1 million would be generally 15%. And we see there's a lot, for the property in some high high-end states for income earners like California or Hawaii. That's why we put here. Don't forget about state withholding tax. Like California is not much, 3-4%ish, but Hawaii would be requiring you to pay 7.25%. So that's pretty harsh if you combine the federal tax and the state tax. And this tax withholding is not based on the capital gain from the property. It's based on the 100% of the sales price. Of course, you can minus some expenses, 100% of the net proceeds. So if you have a $3 million nice house in Hawaii, you're gonna sell it. Probably, let's say, depends on the market. If you don't make much money from that, not much appreciation in the value, you still need to pay like more than 20% of a tax upfront. Then you need to go through the last one here. You need to file your income tax return to claim that refund. Eventually, you don't need to pay much tax because the eventual tax amount will be based on the net capital gain, not the whole sales price. However, the timing, it can drag like more than 1 year or 2-3 years sometimes, because these type of filing is based on the paper filing, takes time. Then sometimes they ask you to provide documents for improvements, some addition cost. So it will take long. Here's a solution here. There is a form, it's withholding certificate, that's RS form. So generally, before you decide to sell your U.S. property, you would approach to your U.S. tax professional sooner rather than later to apply for this withholding certificate. What it does is to provide you opportunity to present to the RS, say, hey, I did not make much money from the property sale. So my actual tax would be much lower than this withholding tax. So can you just withhold or allow the buyers to withhold the tax amount approximately similar to what amount eventually owned? So you have to file that timely, and also that form also takes some time, usually at least like three months. And in reality, in the real world, the escrow company, they hesitate to wait for 3 months to close the deal. So they just withhold the tax and remit to the IRS. However, these forms still give you a chance to claim for the early refund. So that's the important part we just want to highlight. And the last is, we already see a question from Q&A, and it's a long-term and short-term capital gain concept in the US. It's not a Canadian one because Canada only tax on the 50% of capital gain. In the US, if you hold a property more than 12 months, then the capital gain will be subject to lower rate, which is we often call long-term capital gain rate. For the short-term, capital gain will be subject to ordinary tax rate, which is much higher. It's 37 now versus 20% reduced rate. So I just want to quickly cover these. These are the important slides. And I know we need to move forward, and I will let you run, Atif, on the details on the Canadian tax implication from the sales.
Thank you, Cooper. As Cooper was saying, in US, there is a concept of long-term capital gain and short-term capital gain. No such concept exists in Canada. 50% of your capital gain is included in your income and is taxable. And the other thing that you need to consider is foreign exchange rates. Now, foreign exchange is relevant in calculating the capital gain or loss. Generally, the cost base of the property is translated using the exchange rate at the time when you acquired the property. And when you sold the property, again, the foreign exchange comes into play, the spot rate at the time, at the day when you disposed of the property or sold the property. So be aware of the foreign exchange that can increase your gain, or it can decrease your gain depending on the situation. If the currency has not moved in favor of your situation or against your situation. Now, the solution would be to consider principal residence exemption. Now, the Canadian rules allow you to choose your foreign property as a principal residence. As I said before, there are certain rules around it, and you have to make sure that you can claim it as a principal residence. And the second thing you can do is, based on your facts and circumstances, you can do some calculations and determine whether it is beneficial for you to designate your foreign property as principal residence or not. So that's one solution to keep in mind to deal with the capital gain that might get triggered when you sell the foreign property. The other thing is that you can claim foreign tax credits on the taxes that you have paid in the US that can be used as an offset on your Canadian taxes. So that is also something to be aware of. So the problem is that there could be a gain due to the foreign exchange rate prevalent at the time of when you acquired the property and when you sold the property. But the solutions are to consider principal residence, designating your property as principal residence exemption based on the circumstances, your circumstances. And we can always use the foreign tax credits that you paid based on the taxes you paid in the US. So, and if you are renting out the property, as I said before, there is tax on your rental income as well, minus your rental revenue minus expenses. So something to be careful about. Cooper.
Yeah, so rental income will be reported up to the date of the sale. It will be
Right.
a partial year rental income reporting.
Exactly.
Yeah.
Exactly.
Okay. The next, we're gonna quickly mention about the U.S. gift tax. This is important because there's no exemption or any tax relief for Canadians who are subject to U.S. gift tax. And in the U.S., they still have a gift and estate tax regime. In Canada, we often address this type of transfer of property or income generated property by income tax attribution rules. And also, so that's hard part for if you transfer some tangible property in the U.S., let's say the real property owner, only that you want to transfer to your spouse or family member, kids, or your friends, So all of these will be subject to generally 40% of a tax. So it's a bad idea to transfer directly the title to someone else. Also, state level, there is some gift and inheritance tax issue. And when you transfer the title, some local authority, they have some title transfer tax as well. And with all of these, generally, if you really want to give your wealth, part of your wealth to someone else, you would like to sell the US property first. Then have the cash proceeds wire back to your Canadian bank account. Then you transfer to someone. In that way, you will be totally avoid the 40% of US gift tax. You cannot do that transfer directly. And there's no any, even for Canadian tax purposes, the gift, I will let you to run the detail for the Canadian tax purposes. Well, what's the consequences from the gifting?
Right. Thank you, Cooper. And so gifting, if you're gifting to your spouse, then there is a provision available in the income tax rules that allow you to do a rollover of property. What does that mean? What that means is that you can take transfer the property to your spouse and not trigger any capital gain. until the spouse disposes of the property. And so if a spouse transfers his property or her property to his or her spouse at $1,000, just picking a very small number here, just for illustration purposes, then the cost base to the spouse receiving the property will be $1,000 as well. So you have deferred the tax until the spouse sells the property. Now, such transfer is not available if you are transferring property to someone other than your spouse, even to your children. It will be sold at fair market value. Now, as Cooper was mentioning, the US gifting rules and how the treatment of the gift is in Canada, there is a mismatch. And that creates a situation where you might not, or you will not be able to use the foreign tax credits for the triggered by under US gift tax. So gifting generally for this reason is not a good idea if you are working across jurisdictions.
Yeah, in other words, since the US, it does not work in the US side, and you don't want to do that gift at all. So,
right, because of the mismatch, don't do it generally speaking.
Right. Okay, then let's talk about the US estate tax. This is the important concern most of our owners have, because you can predict when you'll be dying, and also even you can plan on that. Sometimes due to your size of your estate size, it's hard to get around the US estate tax. So I just want to briefly introduce the general rules on the US federal estate tax. And, if in the US, people nowadays, they have nearly $12 million US to get exempt from estate tax. In other words, if your worldwide assets is below 12 million US, then you don't need to pay any US tax. But of course, there's some interaction between the gift and the estate. If you have made a large gift during your lifetime, then that amount will have to be reduced from your estate, that $12 million exemption. So it's combined exemption amount. And the tax rate generally is 40%, anything above $12 million is 40%. So that's for the US citizens or people domiciled in the US who are paying US income taxes. So here we're talking about a Canadian, Maple Leaf Canadian. So proud to be Canadian. So what consequences if you die with a US property? So you're treated as a non-resident to the US. General rule is you can only get $60,000 exemption. That's US dollar. It has not been inflation adjusted. It's been there forever. And so it's not good. However, the tax treaty between Canada and the US provides a big relief, because they say, hey, your neighbor is Canadian, we love you, so we provide you exemption. We treat you as a US person. So we're gonna give you $12 million exemption as well. That's great. However, that's not just the US properties value exemption, okay? That $12 million also your Canadians worldwide estate. So no matter it's located in Canada, US, or Europe, other countries, if you combine the worldwide assets, it's below $12 million, you don't need to pay US estate tax to the US. There is some formula, to run. You need to file a tax return to show, to have your detailed the estate, the fair market value as date of death. So lots of details to go through. But general rules is if it's below $12 million, you don't need to pay. However, the two issues here, okay? $12 million is already double the amount if you compare to like prior to 2018, okay? Because that's the year the law changes. However, the sunset rule says after 2025, they're gonna claw back that exemption amount back to the original amount, which is only like $5 million adjusted by inflation. So nowadays, roughly $6 million, okay? Let's say if your worldwide assets is over $6 million, then you die with a US property. At that level, you're fine. Anything above, you need to pay a US estate tax. You need to have a ratio based on your US real property value. Actually, not just this. You could combine all of the US stocks, other type of US titles asset, like your Apple, Microsoft stock in your bank account, investment account, or RSP. You need to combine all of these as US titles assets with your US real property. Then versus your worldwide asset, you get a ratio here. Then your times whatever, $12 million nowadays, or $5-6 million later years. So you get a ratio. That's the exemption amount you can have. But anything about that, you still need to pay estate tax. I don't want to get too complicated. I know most of our audience here, friends here, I would just let you know, you need to file an estate tax return, claim with the treaty benefit position, and you need to submit those timely. If you don't do that, exactrix liability for the potential US estate tax will be always there. So I know some of our audience today is from like trust company and trust officials. So be careful if you don't file or get a certificate of a clearance certificate from the IRS, then you distribute all of the estate assets to beneficiary. Then probably you will be in a very difficult situation, because IRS will go after you, and then you have to go after beneficiaries. Then it's hard to say if the beneficiaries would like to pay the US tax. So I just want to point out this is a very important issue. And I put a joint ownership here. That's an interesting one, because I already saw questions like a few owners own the property. What if one co-owner dies? Then does he or she need to pay the US estate tax? But again, so here's the rules. You need to include your part, the deceased owner's, that ownership, whatever the assets belong to him or her. Then you need to go through this estate tax report regime. However, there is one important rule you need to know is, from the IRS point of view, they don't see you as like a 50% owner or 1/3 of owners, unless you provide a clear the fund or documents that show you only are entitled to that portion. Let's say a mom and dad, let's say a mom contribute 100% of the fund to purchase property, and she put all of the family members on the title. She's only a co-owner. In this case, IRS say, hey, you contribute 100% of fund. So for estate tax purposes, you're the 100%. So you have to include 100% of the value on the estate tax return. So that's the rule. So if you want to document things properly, you need to show each owners contribute their part. So then you can just claim to report your own fraction of that value of the property for estate tax, potentially will reduce. So that's one thing. Another thing is, if sometimes it's good or bad. I mean, there's a plenty of opportunity there. Let's say a husband and wife, own a property, but they are worldwide asset, one deceased spouse, the worldwide asset is below that $12 million threshold. So no matter how high, or you include 50% or 100% of the property value of the estate tax, you don't need to pay any US estate tax. So in this case, you want to put a higher value on the firm. Why? First, you don't need to pay estate tax anyway, either high or low. The benefit would be the surviving spouse will get a higher bump up basis for her. So for US tax purposes. So in the future sale, she will have a less capital gain income from that. So that's case, we had client cases before like that. That's something to keep in mind. I just want to briefly mention some issues around this joint ownership. We're going to talk about later with some details. And I think that's enough for the federal estate tax. Briefly, just remember, state level, they still have some states, not all of them. Some states have the estate tax and the inheritance tax regime. And also some probate is a local issues. Then you need to carefully plan on that as well. So estate tax is a big concern for Canadian if you own the property personally, okay? So I want to move to Canadian tax side. Atif, you want to briefly talk about this Canadian tax rule?
Yes, thank you, Cooper. So under the Canadian tax rules, when a taxpayer dies, there's a deemed disposition of his or her assets. And the same rule applies if the taxpayer holds the property in a foreign jurisdiction, such as the US. And so if the taxpayer has a US vacation property and if he passes away, then there is a deemed disposition. And on his terminal return, tax return, he will have to include the gain. The gain will be included in his terminal return and taxable. Now, as Cooper was saying, that the cost base will be of the person who inherited the property will be equal to the fair market value at the time of his death. So in later years, you have higher ACB to play with for the next taxpayer. But when there's a deemed disposition, then you have to come up with cash. You have to come up with proceeds to pay for the tax liability unless you sell the assets. And that's where the solution, again, could be principal residence exemption. Now, as I was saying before, principal residence exemption is a good solution to some of these problems we are discussing today, but it depends on the facts and circumstances to figure out whether this solution is appropriate for the taxpayer. But that is something you should be aware of, that if you meet the condition, if you designate the property as principal residence, then you can avoid paying the tax on it at the time of the death. Now, you have paid the US estate taxes. So can you use that as foreign tax credit in Canada? Yes, you can. But the way the rules are, the way the estate tax operates in the US, and when we go to the treaty, without getting into too much complexity here, when you go into the treaty, there's a formula that allows you to claim those foreign tax credits. And the end result is that there is no dollar for dollar credit available on the deemed disposition upon the death of the taxpayer.
So Atif, why there's no dollar for dollar? I guess it's because US tax on the 100% of the value, but Canada only taxed on capital gain portion.
Right.
In that way, it's only a fraction of the US tax can be claimed as foreign tax credit.
Right. And there's a treaty formula that helps you calculate it, but the end result could be not dollar for dollar.
Yeah. Okay. So eventually there could be double taxation for the cost part because you pay to the US as well.
Right.
Okay, that's very helpful. And I think with all of these, pros and the cons about how to hold the property, we want to address these options because we talk about Canadian income tax, US income tax, and gift tax, US estate tax, Canadian capital gain tax upon people's death. So with all of these concerns, any solutions to hold the US vacation property? I mean, this is next slide we're going to talk about. There's not easy answer. It depends on people's needs, depends on how many assets you have, what's your purpose of investment, or probably later days you want to move. So with all of these, we have some popular structure people may be aware of, we just put some of the example here. We're gonna navigate the pros and cons. So the first one, it's simple. You own it directly, okay? Either just 100% by yourself. Then all of the things we talk about from previous slides, they apply to individuals, owners. Also, if you own it jointly, there's two options on the title. You need to check the detail. Joint tenant with survivorship, also the tenant in common. So with the survivorship type of a structure, the surviving owners will take the decedent owners that part. Then without any probate, it's easy. Generally, these happens for spouse, between the spouses when you go out to the US market to buy the property. If you're friends, or siblings, sometimes you want to have it as a tenant in common. This means everyone has his shares clearly, even after death. So that part will go to decedent's probate. So that will make things easier. I know the second option, people think about have Canadian corporation here to hold the US vacation home. It's not that popular, but it's possible. Atif, what are your thoughts on this option?
Generally, it is not a good option to have, because if you have a vacation property under the name of the Canadian corporation, and if you are living in that property, vacationing in that property, then you are vacationing in the property that is owned by the corporation, unless you're paying rent to the Canadian corporation at fair market value. There could be a shareholder benefit to consider, and there could be a deemed dividend included in your income. So generally, this option is not what we suggest most of the time, and that's why it's not very popular.
It's true, but still, we see some client case, they set up the structure. I think the purpose was to get away from the exposure to the US estate tax, because here you have a Canadian corporation. When the shareholders dies, he only had that Canadian corporation shares, which is not subject to US estate tax. However, we have seen a case, the lower court case, say, hey, if this Canadian corporation was set up, the only purpose is to hold the US property, only one piece of investment. And then they kind of look through that. It's real. They said the substance over the form principle will apply in this case. So it's interesting to observe these. And I don't want to get complicated, but that is from our experience. I just want to let people know, even though it's a Canadian corporation, it's still risky. And with the those income attribution rules in Canada. So it's not that ideal option for the holding of U.S. vacation home. And the third one, we put a Canadian trust here. No. First, for people who have attended many of webinars before, talk about trust issue. That's you probably know Canada and the U.S. have very different tax law regarding the trust. In Canada, generally, family trust, the grantor and the trustee, they retain lots of power on how to administer the trust. Then for U.S. tax purposes, in this case, in the most cases, the trustee would be deemed to have all of the assets through the trust. In other words, the trust can be disregarded as a trust. And we often call the grantor trust. And also for U.S. estate tax purposes, sometimes look-through rules apply. So if you own the Canadian trust, then they probably will look through the property, look through the trust, deem the property is owned by you. So estate tax may still apply. However, if the Canadian trust is designed properly and with all of the trust deed is drafted in the proper way, you can get away the U.S. estate tax. Often we call it cross-border trust. I mean, it's a Canadian trust, by the residency determination is a Canadian trust, but it's set up to address some cross-border tax issue. So people often say, hey, I'm gonna set up a cross-border trust. The general way to do this is the grantor, they contribute, or they set up the trust, they transfer the money to the trust, then let the trust to buy the U.S. property. So in that way, generally the grantor or trustee, they cannot be a beneficiary. You cannot say, I buy the property, then I put myself also with my family members as a beneficiary, so I can still go to the U.S., enjoy the property. So that will mess up the trust administration from the RS's eyes. That would be a risky, and they probably look, hey, everything you do, it just, you're trying to avoid this because you still have the power on the trust, you enjoy the benefits from the trust, then you contribute the fund to the trust. They say that, hey, these things, they disregard the trust, then you will be subject to U.S. estate tax. So if you have a Canadian trust, you want to do that properly by the timing of your contribution of the fund. You need to pay attention on the administration. You need to set up a trust account in the U.S. All of the expenses, everything will comes through that trust account. Then you cannot put yourself as a beneficiary. However, you can put your spouse, your family members under the trust as a beneficiary, so they can enjoy the vacation home in the U.S. So I just want to point it out, the trust is always complex, complicated topic. It depends on how the trust was set up, the timing of the acquisition of the property, and how to administer the trust property. So everything you want to document properly. So it's always easy to mess up in the real world. So just be careful of that. And some people say, hey, if the trust is too complicated, I want to set up a Canadian limited partnership to get away the U.S. estate tax. So this works better than the trust in some cases. What you want to do, you want to get away from your personal liability. So you will be, like say, a Canadian individual will be a limited partner. Okay, typically you set up a Canadian corporation as a general partner. So you own 99%, the general partner, the corporation owns 1%. So you set up a Canadian limited partnership. Then you hold the US property. So in this way, generally your interest in the Canadian limited partnership is not US property. They don't look through. I mean, in the real world RS, we may make up its own rules by different interpretation of the tax law. They may argue that. However, by some case laws, it's not a US cited property. What you own as Canadian is only intangible property, intangible personal property, which is your interest in the Canadian limited partnership. So in this way, generally you will not be subject to the US estate tax. However, like I mentioned, there is ambiguity there. So sometimes if you really want to be safe, let's say when people dies, then executors, they have the opportunity to elect to treat this Canadian limited partnership as a Canadian corporation. So often we see this as an entity reclassification application. So you file to the IRS, say, hey, you can do that within 75 days retroactively. So when person died, the executor need to make the election timely within that 75 days to treat this Canadian limited partnership as a Canadian corporation. So the benefit is, if it's a corporation, it's not US corporation, it's a Canadian corporation. So the shares the decedent owns as of his death will not be subject to US estate tax. That's like double protection. So it should be safe for that. And that's, just want to briefly talk about this LP structure. However, the downside from this limited partnership structure is you have 3 taxpayers here. If you have any rental income or for inventory sale to report any capital gain. So 3 taxpayer, yourself as a limited partner, then general partner, the Canadian corporation, also the Canadian limited partnership, because it holds the US real property. If the partnership has any US source of income, then 3 taxpayers need to file US tax return and also some state tax return as well. So lots of compliance costs, but for estate tax protection, that's a great idea. The last one we have here is a US LLC, limited liability company. If it's just a single owner, a Canadian owns this, US default rule says it's disregarded. And if it's 2 or more owners, it will be treated as a partnership. However, you have option. Again, just like LP, you can file an entity reclassification application to treat this as a US corporation. But either way, it's a US company or either disregarded, or it's a US partnership. By look through, sometimes it's estate tax protection. You cannot achieve that goal. Also, there is some downside for Canadian tax purposes. I think, Atif, can you provide some details on how the CRA treat our US LLC?
So the CRA treats LLC as a foreign affiliate, meaning that it's considered a corporation. And the fact that, as Cooper was saying, that LLC can be considered a partnership in the US. And so there is a mismatch when it comes to how income is reported in Canada or when it is reported, which means that some of the US tax that you have paid in the US cannot be used as a foreign tax credit in Canada, meaning that it could be subjected to double taxation. So holding LLC directly is not considered a very powerful way or generically a very effective way to hold a foreign vacation property.
That's right. I know under the treaty, they provide some relief if you distribute the income from LLC timely to match that. Sometimes our CRA will provide some relief. But if you messed up, then it could be subject the double taxation. So that's our discussion on these alternative ownership structures. Then we're gonna go to our last slide. I know we still want to save some time for questions. So last slide, we just want to emphasize, if you have not been compliant to all of these income tax, gift tax, estate tax reporting, you need to be carefully think about how to get into the tax authority for these late filings. And then because if you don't file at all, then statute of limitation will not start to run at all. That means it can last forever. The CRA or RS can come back forever until you file the return. Then the 3 years or 6 years statute of limitation starts to run. So get your files in. It will not be 100% perfect, but at least you let the statute of limitation runs. Then the second is the cost basis for beneficiaries. Let's say your gift or your family members get the property interest from you or from your estate. Let's say then in that case, you're probably okay for now, but in the future years when the property is sold, the beneficiaries need to report their cost basis to calculate the capital gain. By then, RS will have another chance to look over any historical transaction on this property. If you report a higher cost basis, you said that's matched to the fair market value at the date of the death of the previous owner, then the RS will say, hey, where was the filings from the previous owners? I don't see that any gift tax filing, any estate tax filing. So that will trigger the audit examination. We had the client cases from some news you probably see. It's after 30 years, RS sent the notice to examine the transaction on the gift made 30 years ago. So just remind you, with all of these, if you have not done anything correctly, just come over to do that correctly. And from CRA's point of view, Atif, there's some voluntary disclosure program there.
Right. So to echo the point that Cooper made with respect to the US tax rules, the statute of limitation does not apply if you have been negligent or you have been reckless, so on and so forth. So if you have not filed, let's say T1135 form that I was mentioning before, then you should consider filing a voluntary disclosure. Now, voluntary disclosure, there is no guarantee that it will be accepted, but if it meets the criteria, if it has been done properly, then there is a good chance that the CRA will provide you with the voluntary disclosure, meaning that any past penalties and interest accruing on those penalties will not be applicable, and you can bring yourself, you can make yourself compliant without paying any past penalties. However, you have to be careful that you do it sooner rather than later if you're thinking about doing it, because if the CRA sends you a notice asking for T1135 form, or asking a question pertaining around that scenario, or if they ask you for a tax return, send you a tax return notice that you haven't filed, and then the voluntary disclosure will not be accepted because it's not voluntary. You are filing something because the CRA has asked you for it. So that should always be kept in mind.
Okay, very good. I think that's wrap up our webinar here, and really appreciate all of our audience time and stay around here. And please let us know how did we do. So how can we improve, and what topics you would like us to cover the next month. And by the way, in the month, we have another similar topic from our webinar, focus on the investment of property. Because today we're focused on the vacation home, but with some accident rental income. But next time we will focus on the real 100% investment in the US real properties. So stay tuned. And also, we only have a few minutes. We want to get some questions. I think my colleagues are reading the questions. Any, please go ahead, let us know.
Thank you, Cooper and Atif, for the presentation. We have received some questions and we will address them. The first question I have is, if you sell property for less than $300,000 in California, are you saying no federal or state withholding?
For the federal, for sure. For state, to be honest, I need to check the details. Every state has a different exempt threshold. But for the federal, if it's below 300 grand US, you don't need to pay withholding tax. However, that's by law. Like I said, in practice, you need to let escrow company know. That's the rules in the Internal Revenue Code here. You know, you need to show these Internal Revenue Code, and even you show to them, they don't buy it sometimes. They said, hey, we always withhold the tax anyway. We don't want to get into the trouble. We're gonna withhold the tax right away, send to the IRS. You deal with that. You file the form, you claim that that will be exempted. So yeah, like I said, by the law, you don't need to pay withholding tax. You need to let the buyers and the escrow company know. But in practice, that could be a little bit different. Okay. Next.
Thank you, Cooper. The second question we have is, do we have to hold the property for a certain length of time for it to be considered a vacation property?
No, if you buy it, you don't rent it out, it's personal use vacation home. There's not any time requirement to qualify that.
Perfect. And then one last question. Do you have to live in the principal residence for more than 180 days in order for it to be classified as principal residence? So I guess a little bit more clarification on what qualifies principal resident exemption.
So generally, without dipping too much into the rules, I mean, but if you have to ordinarily inhabit a place for it to be principal residence, and that's the starting point. So if you have a property in US or in Canada, vacation property, then if you meet that criteria that you are ordinarily inhabiting that property, then it lays the foundation for the argument that principal residence exemption can be claimed. And that's the starting point. And then you go into year-by-year analysis that, hey, if I claim principal residence exemption on this house or on this property as opposed to the other property, what's the gain per year that I can save? So that's the two ways, and that's how the analysis is started.
Okay, I think with that, we run out of time, and we apologize to that we cannot answer all of the questions. But like I said, you have our contact information here. We would love to hear your thoughts, and also we're gonna review the questions. We will stay in touch. And if you have any questions or your client have any questions, just let us know. We're here to help. With that, have a good day and take care.
Take care.
Thanks.